So much of having success in your finances is about managing risks. Well, I've got a useful perspective on how you can best manage the financial risks in your life. I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. I've heard the analogy that financial planning is like pushing a boulder up an incline. And yeah, all that work and stress and effort. And yet, as you make progress, the planning part is you're putting some hedges in there so that if you actually slip and the boulder starts falling down, you've actually got a stopgap, and that your finances won't tumble all the way back down to the bottom of that hill or bottom of that incline. So as you make financial progress and are pushing that boulder up that hill, you're putting hedges in place or stopgaps, risk management sort of pieces in play so that if something negative happens, your finances don't come crumbling all the way down. So if that's the case, what are some of those stopgaps? What do you do? So much of having financial success is about those stopgaps. It's about managing risk. And that's so clear when we talk about investments. And, one of the biggest financial choices that we all get to make is within our investment strategies. Well, how much offense and how much defense do you want to play? When you're setting your investment strategies, you're putting out a hockey team or a basketball team that onto the court. So when you have the ball, you're playing offense, you're trying to score. But instantly that ball can change hands, you all of a sudden lose it, and now you're playing defense. It's not like football where you can, pause and say, nope, I want to get those players off the field and new players on. No, the reaction's very quick. So your investment strategy has to include a risk management component. But what about the other areas of life? How do you best manage risk? Do you avoid it? Should your goal to be self-insured? Should you transfer the risk? What are the best ways to manage risk? Well, it depends on your situation, but it also depends on the type of risk. There is a framework that we like to use with our clients to go through the different areas, the different types of financial risks out there, and use that as a guide to help us determine, well, what's the best way to manage that risk? Let's see if you find it helpful as well. So it's basically a grid, a layout perspective that shows, well, what's the chances of this risk happening? Okay, is it unlikely or likely? And then how severe would the financial consequences be? Low financial damage or high potential financial damage? If we start in the bottom left where there's low likelihood that this would occur and low financial damage, you just absorb those risks. You just live with those risks. And what are some examples of those? This is the common household product, brakes. For us, we recently bought a small little storage. You can't even call it a shed. It's sort of a plastic Rubbermaid sort of deck storage. Okay, and it was a couple $100, enough to fit the deck furniture cushions and some of the toys and whatnot that the kids have. And sure enough, as we're making the purchase, as we're adding it to our cart, then the pop-up comes up where it says, "Do you want to protect your purchase?" And for $60, if something happens, we'll replace it for you. Well, it was only a couple $100 to spend $60 to protect it. No, this is low likelihood that something's going to happen. And if something does happen and a tree falls on the deck or whatever and breaks this thing, you know what? To spend a couple $100 to replace it, I'm not going to enjoy it, but it's a pretty low financial risk as well. So those sorts of risk, pretty unlikely. And even if something does happen, low financial risk, you live with those risks, you absorb them. Now, moving along the grid, what if it's more likely that something could be damaged, but also not very financially severe, not very severe? These are sorts of things like, well, you're going to have, at some point throughout the year, you're probably going to get sick and you're going to need to go see a doctor. Hey, listen, is this strep throat? Do I need to get on some amoxicillin or not? Or maybe a broken window, something like that. Again, high likelihood this is going to happen. You're probably going to get sick once or twice a year, okay? But the financial severity is going to be low. Well, you just try to manage, you just try to reduce these, not manage, I'm sorry. You just try to reduce these. You wash your hands. Tell the kids no playing baseball in the front yard, or if so, use a wiffle ball instead of an actual baseball. Yeah, you want to reduce the risk as much as possible, but there isn't anything greater or above and beyond that you should really do. Just try to reduce the risk. Now, moving along, the high likelihood, listen, this is a risky adventure, and there's very big financial damage if something like that happens. You try to avoid these. So what's an example? Maybe skydiving. So some sort of thrill seeking that, yeah, you know what, something like it's common. There's lots of perils there. There's lots of risk there. And if something really bad does happen, then financially it would be catastrophic. It's hard to transfer these risks because of just the likelihood, the odds of something dangerous happening financially. So listen, we all have our own, thrill-seeking activities, but for the most part, the way you manage these risks is to avoid them. To avoid them as much as possible. Ones that have a high likelihood that they're going to have some a financial loss, and those losses are severe, try to avoid those. And then the last quadrant, low likelihood that it's going to occur, but if it does, financially it is severe. This is the area that you either want to transfer the risk or work with your CFP over time to get self-insured. This is where you're going to find the 5 major financial risks that we all bear, that we all have to figure out how to manage. And that is the risk of a health emergency. So this isn't the strep throat. No, this is the I need a surgery, right? And I'm going to be hospitalized for a couple of days. And therefore, what do you do for health insurance? Health insurance is a form of transferring the risk of a big health emergency and how you manage that. What about the risk of unintentionally causing property damage or damage to someone else? So this is not the broken window, but this is the tree falling on your house, or this is the house fire, or this is the car accident, right? And so getting the right home and auto insurance, that's a way to transfer that risk. You're going to live with the high likelihood ones, the little fender bender, or the broken windshield on the vehicle. That's why you have a deductible, because those smaller claims, no, you're going to absorb those. You're going to try and reduce those, but you're going to absorb those. But it's the big claims, those are the ones that you want to transfer. The risk of passing away early while you have unfunded goals, or maybe a family that's relying on your paycheck. That's life insurance, typically transferring that risk until you get to a point where you're self-funded. The risk of not being able to work and having a disability, that not being able to earn an income. And again, we're all striving towards independence here and not needing to transfer this risk of becoming self-insured when you're retired. But while you're working and you're needing that income to pay bills and to handle lifestyle for the family, yeah, transferring that risk by buying disability insurance. And then finally, the risk of needing assistance with life's daily activities, needing long-term care services, either a nursing home or home health care, something like that. That is an enormous risk that, one that likely you're going to want to transfer or find a strategy to become self-insured. So when you take a look at this paradigm, when you take a look at this grid, this is a paradigm, this is a perspective to help you determine, well, what's the best way for you to manage life's financial risks? And oftentimes, this grid is very helpful to make these risks unemotional, but also help you focus on that lower right quadrant, that one where now it's more rare that it's going to occur, but if it does happen, it's going to be financially devastating. Oftentimes there's a fully functioning insurance market where you can work with your CFP, your certified financial planner, figure out how to get the right coverage in place to transfer that risk. So here's a question. In that bottom right, in those 5 key areas, those 5 key risks that we all need to figure out how to manage, what's your game plan? Have you gone through those with your certified financial planner, looking at all 6 areas of your financial life, figuring out what's the best way to manage those risks? Is it to transfer them and do so efficiently with the right coverage, or do you have a strategy to become self-insured in those areas? Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.